So we discussed global depository receipts, American depository receipts. Then we went on to commercial papers, debentures, securitizations, and trust certificates. Right. So, any questions from that module? Okay. So, if there are no questions, let's move on. To working capital management. Right. Now, working capital is something we have learned when we're in grade 2. Yeah. So, what's working capital? What do you mean by working capital? And how do you calculate working capital?
Your current assets minus current liability.
Very good. The working capital is equal to current assets minus current liabilities. Right? Current assets minus current liabilities. Now, what do you mean by current assets? What comes under current assets?
Cash.
Good. Cash.
Inventory,
Yes.
trade receivable,
Very good. Cash. Inventory. Or your stocks.
Trade receivables.
Trade receivables. Or debtors. Good. Current liabilities.
Creditors.
Creditors.
Short-term loans.
Very good.
Payables.
Payables. Yeah. Right. So current assets and current liabilities. Now, where do you get all of these? In which statement?
Balance sheet.
In the balance sheet. Yeah. So these are also called current assets minus current liabilities, also called net
Assets.
current
Asset.
assets. Yeah. Net current assets. Now, what is the difference between assets and current assets? The difference between assets and current assets. How are assets different from current assets? Yeah. The difference between assets and current assets. What are the other kinds of assets?
Fixed assets.
Yeah, fixed assets like land and buildings, machinery. Then you can have intangible assets like goodwill, or patents, trademarks. How are they different from current assets? Yeah.
Current assets are short-term assets.
Very good. Yeah. Current assets have a short-term maturity, right? Usually less than 1 year. Beyond 1 year are long-term assets. Sometimes you have indefinite maturity with some assets like land and buildings. Then the difference between current liabilities and long-term liabilities, again the tenor. Current liabilities usually have maturities of 1 year or less. Long-term liabilities have longer maturities. So what are long-term maturities or long-term liabilities?
Long-term loans.
Long-term loans. Yeah. Things like that. Right. So today's analysis will be based on these aspects. Now, what do you think is best for you to increase working capital or to reduce working capital? What is best? Working capital, what is best to increase, maximize working capital or minimize working capital?
To have a balanced working capital.
Very good. To have a balanced working capital. You can't maximize it too much, or you can't have very minimal or little working capital, little or no working capital. It doesn't work like that. It's, you can't have too much, you can't have too little. Now, what are the pluses and minuses of having too much or too little working capital? Too much working capital, what happens?
Nothing can be earned out of too much of working capital.
Yes. So you'll have idle funds. Your funds will be idling, right? Which means you will have interest cost. Because now, for example, this marker is working capital for the institute, right? So if the institute wants, it might be able to buy 1 million markers, isn't it? 1 million markers they buy and keep because they want it for their day-to-day activities. Maybe every day, on a daily basis, they might use 5 markers maximum. Like on a very busy day, they might have 5 markers. Okay, so what are the disadvantages of the institute stocking up 1 million markers? One is, yes, your funds are idle. Each marker costs about $100. So to buy 1 million markers, they will need $100 million.
Storage cost.
Storage cost. It adds to storage cost also. To store 1 million markers, they will need a very big storeroom, maybe one entire floor. If not for the markers, they could have rented it out. So it adds to cost, like storage. Then wastage, right? Because 1 million markers every day they use maximum 5, meaning they can use it for about 200,000 days. 200,000 days is about the next 100 years. No? Storage cost. And a lot of money tied up, meaning when money is tied up, one thing is that money is not free, no? Because if the institute was short of money, they would have borrowed it from somewhere, maybe from a bank, right? So if they had borrowed it, then there will be holding cost, interest being charged. Also, if the institute had surplus cash and they had used it to buy pens, they could have, without buying the pens, they could have invested it somewhere and earned interest. So interest is lost either way. Whether you are short of cash or surplus cash, interest is lost. Then storage cost, you can have maybe wastage. Sorry, one of you were trying to say something.
Insurance cost. Insurance cost.
Oh,
Insurance.
Pardon?
Insurance cost.
Oh yeah, insurance, okay. Wastage, then maybe insurance. It adds to cost. What else? Pluses and minuses both. Having surplus working capital. You have excess working capital. These are the positives and the negatives, right? So far we have 2 negatives. What else? No positives? Positives?
Will be able to finance in long-term projects?
Yeah. So positive is, so what you mean is you will never run out of inventory, right? Is that what you meant?
Yes, sir.
Yeah. So there won't be no shortage of inventory. Right. Meaning you can have continuous flow of operations. Operations will never be interrupted. You won't have to stop your operations. Okay. Yeah, good. Then if there's a shortage, these are surplus. If there is a shortage, the points will reverse, no? Because shortage means you're holding on to less working capital, right? Less working capital means you have less funds tied up in working capital, right? So if less funds are tied up in working capital, whatever the funds you have, you can invest somewhere. So you will have to borrow less, right? So you can save on interest. Then you can have less storage. You don't have to have big storerooms. No, one entire floor is not required to store your working capital. But the downside is there might be interruptions to the operation. Right? You might run short of cash. You can't pay your electricity bills or your water bills. Maybe you can't pay your staff salaries. Not enough cash. So there are positives as well as negatives, which means it is very important to balance things out. You have to balance it out. You can't have too much. You can't have too little. You have to strike a balance. Clear? Any questions? No? Right. So it's working capital. Working capital management involves optimizing on your current assets as well as your current liabilities. Right. So it's managing working capital, meaning you must focus on current assets as well as current liabilities. Strike a balance between the two. Yeah. Because for you to increase working capital, either your current assets should go up and current liability should go down, right? Or both. Okay, that means current assets should go up and current assets should come down. Current liability should come down. Yeah. Working capital is the capital of a business which is used in its day-to-day trading operations. Simply the current assets used in operations. Net working capital is defined as current assets minus current liabilities. Current ratio. Very important ratio. Current assets over current liabilities indicates whether a company has enough short-term assets to cover short-term debt. Right? Now, it's very, very important that you cover your short-term debt. Why? Because if you can't cover your debt payments, then your creditors can sue you for bankruptcy. And you might have to file for bankruptcy if you can't service your short-term debt. So it's very important that you have enough cash flows, free cash flows to service short-term debt. Right? Now, that is the case even for Sri Lanka, the country. This week, we have a sovereign bond maturing. It has to be repaid, right? So it's very important that we have enough dollars to repay the sovereign bonds. Because if we don't repay, then that will be a black mark. Yeah? So it applies to corporates, to individuals, even to countries. This, what we are about to study, applies to everyone, not only for corporates, not only for banks. Also to individuals as well as to even countries, right? Now, take yourself as an individual. See, you have short-term payments coming up. No, you have to pay your bills. Then you have to put food on the table for your family. You might have to pay your loans. Right? All these are short-term obligations, loans, which have to be serviced. Right? Now, if you default on any of those, then you're in big trouble. Big trouble, right? the current ratio or current assets minus, current assets over current liabilities indicates whether a company has enough short-term assets to cover short-term debt. Right, so let's write it down. Current ratio is current assets over current liabilities. Now, if you have excess working capital, that means your current assets are very high and current liabilities are very low. Remember the working capital equation? So if you have excess working capital, that means you have a lot of current assets and little current liabilities, right? So when your numerator increases and the denominator drops, then the current ratio will increase. Now the rule of thumb is that your current ratio will have to be less than 2, but more than 1. Less than 2, more than 1, ideally, right? It can be industry specific, but usually the rule of thumb it has to be less than 2, more than 1. Now, the moment it goes above 2, that means you have a very high current ratio. Very high current ratio means you have surplus working capital, excess working capital, above and beyond what you need. Right? Which means if you have surplus working capital, all the issues that we remember surplus working capital, all the negatives that we discussed comes into play. Then on the other hand, if you have very little working capital or insufficient working capital, then you have liquidity problems. Right? So it's very important that you manage between this framework, between 1 and 2, between these two ends. Its current ratio should be between 1 and 2. Anything below 1 indicates negative working capital. If it's less than 1, right? If this ratio is less than 1, that means you have so that's you have less current assets than current liabilities, which means you might come into operational issues, that you might not have enough cash flows. Things like that can happen. While anything over 2 means that the company is not investing excess assets. Most believe that a ratio between 1.2 and 2 is sufficient, right? So you have to be just above 1 and below 2. Then you are making optimal use of current assets. Working capital management. How do you manage your working capital? Any questions up to now? So in your day-to-day lending activities, do you all look at your customers' working capital or your current ratios? Customers' current ratios, do you all analyze? When you do credit evaluations? You don't? No one is doing credit? Yeah. No one is in the credit department? Do you look at current ratios of customers when you approve of grant facilities? You do? Okay, so no one is in the loans department. Everyone is doing marketing or HR, right? Yeah, so working capital management. Now, by the way, remember component of current assets, stocks is a component of current assets. Right? So if you take a company like Toyota, they practice a very interesting concept, which is called what?
Not maintaining stocks.
Yeah. Pardon?
Not maintaining stocks, and stocks are gained by their suppliers.
Yeah. What's that called? Because they maintain zero inventory, no inventory. They order their inventory only when the car is on the production line, right? So most of the Toyota cars are, the manufacturing process is automated. So they will get the nuts and bolts down only when it comes to the production point, right? Before that, they don't have anything. Okay, so the timing is synchronized so that they maintain zero inventory and the production process also flows smoothly. No inventory. That is called, they order inventory just in time, right? So it's called JIT, just in time. Toyota maintains just-in-time manufacturing process. That means no inventory, zero inventory. So they are cutting down on inventory straight away. Right? So their current assets will not have inventory, zero. Fantastic concept, saves a lot of cost, and also the onus is on the supplier to supply products at the right time. Right? If they are unable to deliver at the right time, the supplier is in trouble. Because Toyota's demanding power, bargaining power is very high. They make sure that the suppliers give them stuff right on time, not a moment too soon. Right? Everything that comes early is a cost. Okay, so that's their way of managing the working capital. Working capital management is very important because it will have a direct impact on the bottom line. It has a bottom line impact. So what impact? Whatever affects the bottom line can have consequences to the entire company. Right? Even the staff. Understood? So working capital management is very important. Critical aspect. It can decide whether you will survive in the future or not. Make or break for a company. Right? Because keeping excess working capital is not going to help you. Most companies are struggling with inventory. I'm talking about inventory. Last year, during the height of COVID, you may have noticed that crude oil prices. What happened to crude oil prices when COVID hit the fan? What happened to crude oil prices last year?
Dropped.
Yeah. I think you were right. What did you say?
Dropped.
Crude oil prices dropped because global travel restrictions came into effect. Flights were grounded. No one was traveling even within the country. All the countries were locked down. The whole world was locked down. Even today, travel is very limited. Limited amount of travel. So the whole world came to a standstill. Crude oil not required. Now these oil refineries, they cannot stop production overnight. So they had to continue with their production, and no one was using, right? And they got landed with a lot of inventory, a lot of crude oil. Nowhere to store the crude oil. The storage also has exceeded capacity. Nowhere to store the crude oil. They were in a huge mess. And actually, crude oil prices went to negative levels. Negative, right? Negative $40 a barrel or something. That means if you buy crude oil, they will pay you. Now, normally when Sri Lanka buys crude oil, we have to pay now. So if it's $60 or $70 a barrel for every crude oil barrel that we purchase, we have to pay. But when crude oil prices go negative, rather than us paying them, the supplier, they pay us. Why? Because for one thing, they had no inventory. If they were to store this excess crude oil in inventory, it will cost them maybe $50. Right? So if there is no buyer, it will cost them $50 to store crude oil. So it is cheaper for the manufacturer or the supplier to pay $40 to the buyer and give him crude oil. He still saves $10. Okay, so crude oil prices went negative. Nobody wanted crude oil. Yeah. Very interesting concept that was. First time in the world. Huh? First time in the world. So this is what Corona has done. COVID has it has become a new norm. The way even lectures are done, classes are conducted, has changed. Right? So it has turned the world upside down. Okay. Meaning working capital management is crucial. It can make or break the company. Working capital management is a managerial accounting strategy focusing on maintaining efficient levels of both components of working capital, which are current assets and current liabilities, in respect to each other is known as working capital management, right? So it's actually a science. Working capital is a science. This ensures a company has sufficient cash flows in order to meet its short-term debt obligations and operating expenses. So you should have enough liquidity to meet short-term debt obligations and operating expenses. Implementing an effective working capital management system is an excellent way for many companies to improve their earnings. Okay, so that's why Toyota is practicing this to the maximum. Effective working capital management is an excellent way to improve earnings. Earnings means bottom line, the profits. So if you can reduce the cost of working capital, because every asset has a cost now, if you can reduce the cost of that asset, in this case the working capital cost, it will enhance your working capital, boost your working capital. The two main aspects of working capital management are ratio analysis and management of individual components of working capital. Right? So you can look at ratios, like for example, the current ratio. Then there is another ratio called the acid test. Right? The acid test. Is your current assets minus stocks divided by current liabilities. Okay, so they are removing the component of stocks from current assets. Any idea why? Why do you remove stocks, the impact of stocks from current assets? Now, one thing is, if you remove stocks, then for companies like Toyota, their current ratio will be equal to asset test, because stocks is zero. When stocks are zero, your asset test is also current assets over current liabilities. Right? So there is no difference between current ratio and asset test for companies like Toyota. But any idea why do you remove stocks? Why remove stocks?
Which cannot be converted to cash at a short time.
Yeah, very good. That's one reason. Stocks is difficult to convert stocks into cash. Right? Stocks are relatively illiquid. Okay, so converting it to cash involves a whole lot of other procedures. Maybe your marketing or your sales should increase overnight. You have to finish it, complete it. Right? So you have to go through a lot of trouble, a lot of pains to sell it off and convert it into cash. So that is one reason to remove stocks. The other thing is, now stock valuation can be subjective, isn't it? Subjective, meaning it's very difficult to assign a value or values your stocks. Very, very subjective. You may have noticed with some of your clients, if you go for inspections, they might show you a whole lot of stocks. Right? Some at varying degrees of completion. Isn't it? You go to a vehicle manufacturing plant, you might see that in some storerooms, you have only the frame. Then you have cars which are 50% complete, some which are 75% complete, some 80, 90%. Right? So how do you assign a value to these? Very difficult. Very difficult. Then because at each completion, there is a value addition. Right? So some companies include the value addition into the stocks. Some don't. So there is a lot of subjectivity in stock valuations. Very difficult to value a stock. And it can, now if your stocks are overstated, right? Let's say for example, you have current assets 200 and current liabilities 100. Okay. Out of this current assets of 200, let's just assume there are two companies operating in this industry. Both have current assets 200, current liabilities 100. Right? Company A might say it has stocks worth 100. Stocks 100. Whereas B, at the same level of completion, might say we have used better raw materials. Our stocks are worth 150. Now, how do you decide which one is correct? Very difficult, right? So the best thing is to leave stocks out. Stocks you don't need. Yeah? Then it's your current assets over current liabilities. Sorry, current assets minus your stocks over current liabilities. So you're removing the impact of stocks. Whatever the valuation you have given for your stocks, you need to remove. Okay, so the distortion of your balance sheet is less when you remove stocks. Right, so that's one way of this is one way of managing working capital. All right, now this cycle, it's actually called a cash conversion cycle, or your working capital cycle, is where, well, let's start from one point, right? Because you buy goods on credit, you buy your inventory or your raw materials on credit, right? And maybe you might settle your creditors in 3 months. So what you buy goes to the inventory. It might be there for about a month, right? And the inventory then gets converted into stocks. They will be sold on credit to your debtors, who will take another 1 month to settle you. Okay, so you have your raw material stuck in inventory for 1 month, and when you sell it, your debtors will take another 1 month to settle you, right? So you will be receiving cash. Your cash will come only in 2 months. And you have asked for 3 months credit from your creditors, right? So you are getting cash in 2 months. Let me draw it on the board. This is today. You are buying inventory on 3 months. Sorry, you are buying raw materials for 3 months credit. From your creditors. Right, so you get 3 months credit. Then whatever the raw materials you buy, you maintain in your inventory for a period of 1 month. So this takes 1 month for you to convert your raw materials into a finished product, right? So maybe you might buy plastic, and for it to go through the extrusion processes and the finishing processes, it takes you 1 month to convert it into a marker, right? 1 month. Then you sell this marker on credit, maybe to IBSL, and IBSL takes 1 month to settle you. So 1 month credit for your debtors, right? So the debtors take 1 month to settle you. Now, after 2 months, you will be receiving cash. Right? 2 months down the line, you will be receiving cash. You will convert your raw materials into finished goods, and the debtors will take another 1 month. So 2 months down the line, you will receive your cash. You're getting cash here. And you have to settle your creditors only 3 months down the line. Right? So you have 1 month where your cash is available. You have free cash with you for 1 month. Okay. And if that is the case, then you have a decision to make. But you can't let these funds idle. 1 month you can keep the funds until the payment date for creditors come up. Okay, so you have 1 month to play around. Now you can decide what you are going to do with the money. You know the planning horizon, it is 1 month. You know how much you have to pay. You know how much you have in hand. You know whatever the other cash flows that are coming up. So looking at all of this, you can decide what to do with your surplus cash. You have surplus cash left. What are you going to do with it? Okay, so that is the kind of decision that you can make. How are you going to use the cash during this 1 month? How are you going to invest it? Maybe you have surplus cash. You can invest it somewhere and earn an interest. Okay, if you earn interest, it will add again to the bottom line. On the other hand, let's say you keep your inventory for 2 months. Not 1 month, but your inventory is there for 2 months. Right? 2 months. Then you sell it on credit and your debtors take an additional 2 months. Your debtors take an additional 2 months to settle you, right? So meaning from the time you purchase your raw material, you will receive cash only in 4 months. Right? Whereas you have to pay your creditors in 3 months. Yeah. So you are getting cash in 4 months, but you have to settle your creditors in 3 months. So you are going to be short of funds for 1 month. If you are going to be short of funds, then you need to bridge that gap. What is your strategy to bridge the gap? How can you do it? Are you going for a bank loan, an overdraft? Are you going to negotiate with your supplier and ask for an additional month of credit? Or are you going to talk to your debtor and tell him to pay within 1 month? Are you going to buy less stock so that you hold it for a low period? Right. So things like that can be decided. Okay. So this is what you need to manage. Because if you are going for some funding facility, funding arrangement, maybe an overdraft for a period of 1 month, you have to pay interest. Right? You have to pay interest. So let's say you have to pay interest at 10%. The bank is charging you OD interest of 10%. For the bank to charge you OD interest of 10%, and the cost for you, or in other words, the return that you expect by giving this kind of credit to your debtors is 15%, then it is worth to run this gap, this difference. But the return you get is 5% and it's going to cost you 10%, then you're going to lose money. Right? So that is when you have to take action. You either have to increase your credit period or you have to talk to your debtors and reduce their credit period. Right? So this is the real management of working capital. How can you decide what to do? Okay. And it's called a cash conversion cycle. From the time you purchase on credit up to the time you receive cash, it's a cycle. Cash conversion cycle. Okay. So you have your inventory days plus your debtors days and creditors days. The difference of that gives you cash conversion cycle. So this is your cycle. Your cycle is a 1 month cycle. It's your inventory days plus debtors days minus creditors days. How are you going to manage this interim period? Cash conversion cycle. Here you have a shortfall, so you have to borrow. The early example, you had a small surplus. You're getting cash in advance. Even then, you have to make decisions. How are you going to utilize that? Sometimes it's not that you always have to be positive, right? It doesn't have to be positive all the time. It can also be negative. It's up to you. It's okay to borrow. It's okay to lend, for as long as you don't idle funds. You have to make sure your funds are not idle. Then you will benefit. Any questions up to now? No questions? Cash conversion cycle, it's a cycle that we just discussed. It's a metric that expresses the length of time in days that it takes for a company to convert resource inputs into cash flows. The cash conversion cycle attempts to measure the amount of time each net input of money is tied up in the production and sales process before it is converted into cash through sales to customers. It measures the amount of time each input of money is tied up in the production process and sales process before it is converted into cash through sales to customers. The cash conversion cycle is a combination of several activity ratios involving accounts receivable, accounts payable, and inventory turnover. Like accounts receivable, your debtors; accounts payable, your creditors; and inventory turnover. The ratios indicate how efficiently management is using short-term assets and liabilities to generate cash flows. Because that's a very important point. Cash conversion cycle, the ratio indicates how efficiently management is using short-term assets and liabilities to generate cash flows. To calculate cash conversion cycle, excuse me. To calculate cash conversion cycle, you need several items from the financial statements. Right? So these items you will need, you have to look at both the P&L as well as the balance sheet. You need the revenue figure, right? Annual revenue. What is your turnover? Then the cost of goods sold. Right? Remember, cost of goods sold is the opening stocks plus purchases minus the closing stocks. It gives you cost of goods sold, isn't it? The P&L. Sorry. You have your revenue for the turnover, then your cost of goods sold, which is your opening stocks plus purchases minus closing stocks. So this is, you have to minus from your cost of goods sold. The total figure has to be a minus. Then the difference between your revenue or the turnover and cost of goods sold gives you the gross profit. So this is a simple balance P&L. You need to look at your revenue as well as cost of goods sold. Because the net of that gives you the gross profit. Right. Then you can calculate your other ratios, which you all might remember. Gross profit divided by sales gives you the gross profit margin. Meaning that is gross profit divided by sales gives you a GP margin. Okay, meaning for every unit of sale, how much gross profit are you making? Now this is also a very important concept, because if you can reduce the cost of goods sold, your gross profit margin will increase. Why? Because when cost of goods sold reduces, your gross profit increases, isn't it? Let's say, for example, your turnover is 1,000 and your cost of goods sold is 900. then the gross profit is 100, right? So your gross profit margin will be 100 divided by 1000 into 100, 10%. Whereas if you are able to reduce your cost of goods sold, so let's say there's another company which has the same turnover, but the cost of goods sold has reduced to 800, then you end up with a GP gross profit of 200. They will have a GP margin of 20%. Right? What do you think is best, to have a GP margin of 20% or to have a GP margin of 10%? What is the best? What is best?
20% GP margin.
20% is best. %20 is best. Because higher the GP margin, the better. Right? Because it's the gross profit that can absorb all your other expenses. Every other expense that comes after your GP margin will be absorbed by the gross profit, right? Might be your admin expenses, your finance cost, marketing expenses, all that, or your capital expenses, everything comes after the gross profit. Right? So it's a gross profit that looks after all other expenses. So to calculate cash conversion cycle, you need several items from financial statements. You need the revenue and cost of goods sold from the income statement, right? So this is the P&L or the income statement. Inventory at the beginning and at the end of the period. Right? The inventory comes in the balance sheet. Then you need accounts receivable at the beginning and at the end of the time period, and accounts payable at the beginning and at the end of the time period. Now these are three components of working capital, isn't it? Inventory is a part of current assets, accounts receivable part of current assets, and accounts payable is a component of current liabilities. Right? So you need all three, the opening balance and the closing balance. Then you need the number of days in that period. How many days? Days inventory outstanding. Yeah, so this is the first ratio that we come across. Now these ratios you all need to memorize. There's no way out. You need to memorize, you need to understand them, you need to be able to interpret. Might get tested at the exam. First one is days inventory outstanding. Right? So days inventory outstanding gives an indication of how long you hold on to inventory. Now, inventory is an asset side item or a liability side item?
Asset side.
Asset side item, right? How long are you going to hold on to your inventory? That is given by days inventory outstanding. What do you think is best? The longer the time period, the better, or the shorter the time period, better?
Shorter time period.
Shorter time period, better. Yes, correct. Why? Why is short time period better?
Cash and through selling the items.
Sorry?
Cash and through selling the stock.
Yes, yes. Because the shorter the time period you hold on to, it gets converted to cash faster, isn't it? Now, for example, if you're holding days inventory for 50 days and the competitor is holding inventory for 100 days, it means you're more efficient because you're holding inventory only for 50 days, whereas the competitor is 100 days, right? So if your days are 50, that means every 50 days you convert your inventory into a sale. It takes you 50 days to convert your inventory into a sale, whereas your competitor takes 100 days to convert the inventory into a sale. So days inventory outstanding addresses the question of how many days it takes to sell the entire inventory. The smaller this amount, the better. Okay, so this ratio is very important. Okay, sorry, Harshini, I just saw your question. Cash conversion cycle. Okay. Right. Yeah. So like I explained before, now let's say you're in the manufacturing process of your job or your company manufactures markers, right? Markers. They manufacture markers. Now to manufacture the markers, you have to buy plastics, then you have to buy ink and all that. Yeah? So let's say you get a 3-month credit period from your supplier. Your supplier gives you a 3-month credit period. Okay, meaning you buy your raw materials and you need to pay only after 3 months. Right, you need to pay only after 3 months. By today, you can hold on for 3 months. Okay, so let's also assume that you buy the raw materials today and it takes you 1 month to manufacture a marker, right? For you to convert the raw material into a marker, it takes you 1 month. So you hold on to inventory for 1 month. And then after 1 month, this is complete. You have a complete marker. Now it's still in your inventory. After 1 month, you sell it. You sell it to a buyer. And maybe you sell it to IBSL. And IBSL takes, let's say, 2 months credit. It purchases from you for 2 months credit. Right? So you have a debtor who will settle you in 2 months. Sorry, let's say 3 months. 3 months. Okay, let's start with 2 months. 2 months, right? So you hold on to inventory. You take 1 month to complete the product, and then you sell it on 2 months credit. Someone buys it on 2 months credit. Right? Now, if you look at this, you have to pay for your purchases in 3 months. And you will receive your cash after 3 months. Right? 1 month it is there in inventory or your stores. After you sell, your debtor will pay you in 2 months. So you take 3 months to recover the cash. The debtor pays you means at the end of the 3rd month you get your cash. Okay, so 3 months you're holding on to the asset for 3 months, and after 3 months you get the cash. Now the asset takes various forms. First, it's in the form of inventory, and after you sell, it becomes a debtor. Right? The inventory has got converted to a debtor. Then at the end of 3 months, you get cash. Right? So you start with inventory, becomes a debtor, and then cash. Now using the cash, you can settle your supplier. Okay, so this is a perfect match because you're getting cash in the 3rd month, and using that cash, you can settle the supplier. But this might not be happening every time. Okay, because sometimes your debtor might ask you, if it's IBSL, they have bigger bargaining power, they might ask for an additional month's credit. So it's not 2 months, but 3 months credit. 3 months credit, right? So if that is the case, you get your cash after holding on to 1 month in the inventory, you sell it, and you get your cash only on the 4th month. This is where the cash comes. Cash inflow comes here. Whereas at the end of the 3rd month, you're supposed to pay your supplier. And your supplier will come and ask for the money after 3 months. But you're getting cash in 4 months. Now that is what we also do now. If we feel that next month we are getting a bonus from office, right, we might start spending lavishly on credit cards this month, isn't it? Why? We know that the cash flow is coming next month, so this month we buy on credit. Okay, so we get a loan or we get a personal loan, 1 month. Things like that. Okay, so you in this case will have to bridge this 1 month. Yeah. you may have to borrow at this point so that you are able to settle when you receive the cash after the end of fourth month. But on the other hand, meaning you're 1 month short, so you're short of 1 month cash, you're short of 1 month. Why? Because you have to pay your supply the third month, but you're getting the cash only after 4 months. But what if you're giving only 1 month credit to the debtor, only 1 month? You give only 1 month credit to the debtor. Right? So you hold on to inventory for 1 month, you sell it on credit and get the cash in 1 month. He gives cash at this point. You receive cash after 2 months, but you have still another 1 month to go until you settle your supply. Right? So you're getting cash in the second month. You can hold on to the cash for 1 additional month, and you have to pay at the end of the third month. Right? At the end of the third month. Meaning, you get cash here, then you have surplus cash, and you can enjoy the cash for 1 month before you pay. Right? You will have the cash for 1 month before you pay. So that cash can be invested somewhere. You can earn interest for 1 month. Understood, Darshan? Okay. Yeah, any more questions? Yeah, so these ratios, days inventory outstanding. Calculated as your average inventory divided by cost of goods sold, 365. Okay. It says cost of goods sold per day. How it comes is total cost of goods sold divided by 365. Okay. In grade 2, we have learned that it is equal to into 365. Days inventory outstanding. Okay, you need to remember this formula. Days inventory outstanding addresses the question of how many days it takes to sell the entire inventory. The smaller this number, the better. Lower is better. Smaller is better. Smaller is not always better, but in this case it is better. This addresses the question of how many days it takes to sell the entire inventory. And the smaller this number, the better. And the equation is given: average inventory divided by cost of goods sold per day. Average inventory is beginning inventory plus closing inventory divided by 2. Days sales outstanding. This is your average debtors divided by your revenue per day how much credit are you extending? Day sales outstanding looks at the number of days needed to collect the sales and involves accounts receivable. Right? Accounts receivables are debtors, while cash only sales have day sales outstanding of 0. People do not use credit extended by the company, so this number will be positive. Get smaller the better. Smaller the better. Days sales outstanding is average accounts receivable divided by revenue per day to 365. And average accounts receivable is beginning plus closing divided by 2 on accounts receivable. Then we have days payable outstanding. Which is your average creditors divided by the cost of goods sold into 365. So it gives an understanding, an idea of how long you take, how much credit you are getting from your creditors. How much credit are they willing to extend you? Now, what do you think? When it comes to creditors' days, which is better? Longer is better or shorter is better?
Longer.
Yes, longer is better. Why?
Because we have time to pay the creditor.
Very true. Yeah, quite right. Now, the best example I can quote is if you are looking to buy a credit card, and if you're going for a credit card, you will prefer a bank which gives you 30 days credit or a bank which gives you 50 days credit. What do you all think?
50 days.
Yeah, 50 days is better, no? Longer the credit period, the better, right? So likewise, from your creditor side, now this is a classic example of where bigger the better. Okay? It's bigger the better. Days payable outstanding involves the company's payment of its own bills or accounts payable. This can be, if this can be maximized, the company holds on to cash longer, maximizing its investment potential, and therefore the longer days payable outstanding is better. Days payable outstanding is average accounts payable divided by cost of goods sold per day. Okay, so shall we try this example? Let's try this example. Yeah. Finished. By the way, now there's inventory and there's sales outstanding. Right? You were talking about inventory as well as your debtors, both on the asset side. So when it's on the asset side, the lower the better, because then you get your cash faster. But days payable outstanding is with your something to do with creditors. If it's creditors, that means it involves a payment. Settlement of creditor involves payment, which means the longer the better. Right? So on asset side, the shorter the better. Liability side, the longer the better. So let's try this. You are supposed to calculate days inventory outstanding is your average inventory. 1,750. I'll work in thousands. No, I'll do the full. Plus divided by cost of goods sold, 8 million into 365. So this is average 2 million divided by 8 million is 1/4 of this 91.25. And you get it in days, 91.25 days. Now, what does it mean? What does 91.25 mean? You got a beautiful answer of 91.25, but what does it mean? Yeah.
Inventories have not been sold.
Yes, it means from the time you purchase your raw material or your stock, you hold on to it for 91 days. It's 91 days the inventory is with you. You're holding on to 91 days of inventory. Then the days sales outstanding is your average debtors. Account receivable, let's say this is the average that is being given. 657,534 divided by your revenue, 10 million into 365. That's 24 days.
Yes.
And your days payable outstanding, average payable, let's say 657,534. Coincidence, huh? That's average debtors and average creditors are the same. Pure coincidence. Average creditors divided by the cost of goods sold is 8 million.
Days.
Pardon? 30 days, yes. Yeah. Right. So days inventory outstanding of 91 means you're holding on to inventory for 91 days. Then days sales outstanding of 24 means 24 days means you are giving 24 days of credit to your customers. And days payable outstanding is 30 days means your suppliers are giving you 30 days of credit. Right. So if you just draw this on a small diagram, you're giving your inventory is there for 91 days. Inventory. Right? And then you're giving 24 days of credit on top. So debtors take 24 days to settle you. And you're getting 30 days from your creditors. Okay. So this is 91 plus 24 is 115 minus 30 is about 85 days. Right. You have to settle your creditors in 30 days, whereas you take 115 days. This is 91 plus 24 is 115. No? You're getting cash in 115 days. But you have to pay cash in 30 days. So you're short of cash. You're going to be out of cash for 85 days. Isn't it? 115 minus 30. 85 days out of cash. Right? So now you know you're going to be out of cash for 85 days. If you know that, then you should strategize on how to bridge the gap. What are you going to do during that 85 days? How are you going to fund this? Are you going for a bank overdraft? Are you going to negotiate with your suppliers? Are you going to negotiate with the customers? Or are you going to try and cut down on your inventories? Why are you holding so much of inventory? So all these things need to be looked at. Clear? Sanjeev got 91 is okay. This sales outstanding is you got 12. Oh, okay. You took average. That's what. Okay, that's fine. Yeah, you don't have to change anything. You can make an assumption that 657 is. Okay, you took it. Yeah. Right, so you took opening in stocks as 657534 and closing as 0 and divided by 2. That's how we got the average of half of it, basically. Yeah, that's fine. For as long as you understood the concepts, it's okay if you make mistakes with the numbers, but I hope you understood the concept, right? So now we go on to the cash conversion cycle. What you need to do is very simple. Just add the asset side and minus deduct the liability side, cash conversion cycle. Okay, so your cash conversion cycle is your days inventory outstanding plus days payable outstanding, sorry, days sales outstanding minus days payable outstanding. This equation you need to remember. You need to remember this. And in this example, days inventory outstanding is 91, days sales outstanding 24, days inventory outstanding is 30. You end up with 85 days. 85 days. That means it takes you'll be short of cash for 85 days. Okay. It gives if it pops up positive figure, it means you're going to be short of cash for 85 days in this case. Clear? Any questions? No questions? Right, so if there are no questions, let us move on. Working capital trade-offs, right? So this is basically what we discussed at the beginning. What happens if you extend or if you increase your working capital excessively? That means you increase your either your current assets excessively or you reduce your current liabilities excessively. Then what happens? Now, if you increase your accounts receivable, that means you're giving, you might be extending additional days of credit to your customers, right? Instead of 91 days, you might be going up to 150 days, for example, something like that. Then your customer will be happy. No? Like making your wife happy, it's easy to make your customer happy if you give additional credit, right? They will be willing to buy more and more from you because they have to pay only in 5 months. But it's going to cost you a lot. You will have to pay through your nose. Then you'll have to run after your customer. After 5 months, the fellow might forget. Finance cost will go up. Right? You'll have to keep borrowing from banks. But if it's too low, if you're not giving enough credit, your customer will not be happy. Right? Like it's worse than your wife not being happy. Well, maybe the wife not being happy might be worse, but your customer is not going to be happy. He's not going to come back to you. Sales might drop. But on the positive side, it might be less expensive, it might cost you less. Why? Because you might be saving on interest cost. Right? You don't have to fund it. So instead of extending for 91 days, if you can reduce it to 50 days, you will save on some funding cost. You don't have to borrow from banks to bridge the gap. But your customer will be dissatisfied. Right? So it's very important that you strike a balance. How do you strike a balance? Maybe based on perhaps your competitors' action, what are the competitors doing, or your customer expectations. Maybe the customer doesn't expect 91 days. He might be happy to settle in 60 days and finish it off. Right? Things like that needs to be looked at. The accounts payable and accruals. If it's very high, and if your accounts payable is very high, it reduces the need for external finance, right? But your suppliers will be unhappy, isn't it? Because if you are buying on credit and you want to maximize the number of credit given to you, from 30, if you want to increase it to 50 or 60, you might have to go to your credit and tell them that you want additional days of credit. Now, this fellow might not be willing to give you additional credit. He might not be happy with it for various reasons. Maybe he's not happy with your credit quality. Maybe he himself has cash flow problems. Right? So for those reasons, he might not be willing to extend. So by asking for additional credit or additional credit period, you might be making the supplier a little unhappy. And also, if the supplier agrees, if he agrees to extend it up to 50 days, then you might have, well, you don't have to go to the bank, isn't it? Because in this cash conversion cycle, and in the cash conversion cycle, if days payable outstanding increases to 50, your funding shortfall, right, will drop to 65 days. You will have to only fund for 65 days and not for 85. So your interest cost is going to go down. You're going to be happy about it, but may not be, your supplier might not be happy about it. Then if your accounts payable is at a low level, your supplier will be very happy. Right? He will be overjoyed, isn't it? Meaning if you're paying on cash, you're paying cash basis, you don't ask for credit, your days payable outstanding will be 0. You'll be paying immediately. Right? So your supplier will be very happy. If the supplier is happy, he might be able to increase, he might be willing to increase his supply from you. He might be able to give you additional benefits, maybe more discounts. Right? So that's another point that you have to look at. Now, if the supplier is giving you discounts, or if he is giving you credit, right? Let's say he charges 10% interest for a month. Okay, or else, yeah, 10% interest for a month. Or he tells you, you pay on the spot, I'll give you a 5% discount. Then which one will you prefer? On the spot payments, 5%. Right? 1 month credit, 10%. Which of those two options would you prefer? If you're handling purchasing, which one will you recommend? Yeah.
1 month.
1 month. Okay, reason? Why will you prefer to take the 1 month credit? For what reason?
Because of the 10%.
Yeah, 1 month, 10%. Okay, but 10% is annualized, no? %10 is annualized, right? It's like this. So let's say you have to pay your purchased goods worth $100, right? And purchase value is 100, right? So if you get 5% discount, comes to, you have to pay only 95, but you have to pay immediately, isn't it? It's immediate. 5% discount immediately, you pay 95, right? And let's just assume you're borrowing from the bank at a rate of, let's say 15%, right? 15% interest you're borrowing from the bank. So this 95 will actually cost you after 1 month, 1 plus 15% over 12, isn't it? This will be an actual cost after 1 month because you're getting a 5% discount, but you have to borrow that amount from the bank. Okay. I'm just comparing the two options. The other one is to he charges 10% for 30 days credit. Which is about 96.19. your effective cost is 96.19 after 1 month. But on $100, if he charges 10% interest, it's 100.83. And so if you are in charge of purchasing, the 5% discount option will give you the lowest cost, 96.19. Whereas if you go for 10 days, 30 days credit, it will cost you 100.83. And so you have to then recommend go for the 5% discount. Okay, that's where you need to use some common sense. Understood? Clear? Ezra, you got it? Understood?
Yes, sir.
Okay. Right. So working capital trade-off. Now, if you have excess working capital, that means your what you could have invested elsewhere is tied up in working capital, then your on one side it is going to increase your interest cost, and it will reduce your investment opportunities, right? So it will have a negative impact on the bottom line. Your profitability will be low. But on the other hand, if you have low working capital, your profitability will be relatively high, because you can invest the amount that is released from working capital can be invested somewhere, or you can even settle your borrowings, right? So your profitability will have a positive impact if your working capital is low. But on the risk side, if you have excess working capital, you are running low risk. Why? Because you will never run short of stock, right? There will never be an operational issue. But if you have low inventories, then there might be operational issues, isn't it? Now, if there is a lockdown all of a sudden and it's difficult to get down your raw materials, then you'll have issues if you have low levels of inventory. That's it's very subjective. It's the individual company's policy that decides how much of working capital to maintain. Working capital financing policies. Now, depending on how aggressive or defensive you are, you can have three different policies. First one is aggressive. What does it mean? Well, it basically means is, now in this example that we did, the cash conversion cycle is 85 days now. How are you going to match this? Right? Are you going to go for the 85 days? Are you going to ask your bank to increase your give a loan or a facility for 85 days, or are you going to use some other means? Meaning, are you going to ask your shareholders to give you more money, or are you going to raise a long-term debenture? So there are various ways to fund this 85, right? If you are very conservative, what you will do is you will go to your shareholders and you will tell them, we need a little more cash, so that we can increase the working capital cycle from 85, we can bring it down. And holding on to cash, excess working capital of cash. That is one way. That means you are funding now capital. Now you ask your shareholders to pump in more capital. Now, capital is long-term liability, right? Long-term liability. Or if it was a debenture, it's still a long-term liability. So you're funding your you're funding your working capital requirement with a long-term liability. Then you are very conservative. You don't want to take a chance. But if you go to a bank and ask for overdraft, then you're depending on the bank to give you a facility whenever there is a requirement to fund working capital. And then you're aggressive. Okay. So you can either be aggressive, conservative, or moderate. Now, aggressive means you use short-term financing to finance your assets. Right? You're using aggressive is you're using short-term finance to finance your assets, right? Mainly your fixed assets or your working capital. Short-term, that means You use overdraft to buy a piece of land, or you use overdraft to buy, invest in your working capital, fund your working capital. That's called aggressive. Conservative is the other extreme. You use long-term equity, mostly equity, for fixed assets and current assets, right? So conservative is the other extreme. You use long-term financing to fund every need of yours, maybe fixed asset financing or working capital financing, both done using long-term capital. Moderate is you strike a balance somewhere in between. You use the best of both worlds. You try to use the best of both worlds. You have enough of capital, equity capital, as well as long-term borrowings, and also you have short-term borrowings as well. So that you're somewhere in between. Right? You're never short, you're never long. In between. If you look at this graph, right? If you look at this graph, it will show the amount of fixed assets that you have, right? The amount of fixed assets you have over a period of time, the fixed assets might increase. How you fund your fixed assets, and then on top of that you have your working capital, right? You might have temporary working capital or permanent working capital. How you are funding it will decide whether you are aggressive or conservative. Okay. See, in this graph, it shows that long-term financing has been used to fund part of the fixed assets as well as working capital, right? You have used long-term funding. Then a certain percentage using short-term loans. Okay. Now the point is, if you reduce it further, if you reduce this dotted line further, this dotted line, if you reduce it further, maybe up to this point, that means you have become a little more aggressive, right? You have funded your fixed assets and your working capital, maybe permanent or temporary, using you have funded your fixed assets as well as working capital. If the dotted line is lower, it means you have funded these assets using shorter term funding options. Right? More have been funded using short term funding options, whereas the long term funding component has reduced. Okay, so the lower the dotted line, the more aggressive you are. But if you increase the dotted line, right, even your temporary short-term working capital is funded using long-term liabilities like stocks or debentures, that means you have got very, very conservative. It means you are not willing to go for any short-term debt, right? You're very conservative. You're playing it safe. Now, what sort of companies you think will prefer conservative? Will be conservative, and what sort of companies will be aggressive? What type of companies will use aggressive working capital management, and what will use conservative working capital management strategies? So if you are a mature firm with plenty of reserves, a long track record, huge bargaining power, which strategy will you use? Will you be conservative or will you be aggressive? A mature firm, maybe like John Keel's, will you try to be aggressive or conservative?
Conservative.
Conservative.
Conservative. Right. Well, actually, you can afford to be aggressive, isn't it? Because you can dictate terms to banks. You can ask them to give you facilities as and when you want. Banks will come running after you to give facilities, right? Because then you can be aggressive. You're big, you have enough reserves, you have loyal set of customers. Banks are very loyal to you. They do not want you to move out of them. So you can be very aggressive. You can use short-term funding to fund most of your assets, even your fixed assets to a certain extent. But if you're a newcomer to the industry, right? You are very new. You want to build confidence amongst your suppliers. You want to build confidence amongst your customers, and you don't want to take chances and run out of any inventory. If there's a shortage, then you might have to be a little conservative, right? Because the bigger you are, the more aggressive you can be. But if you're a small fish, then you may have to be a little conservative, right? That is my view. But if you feel the opposite, yes, there is no hard and fast rule. You can, for as long as you can justify, yes. Any particular reason that you mentioned, you can be conservative if you're big?
Diversification is available.
You can diversify, okay. Diversify meaning diversify into a new business, right? Like John Keats has done.
Other sectors, yeah.
Okay. So what are the advantages of short-term debt versus long-term debt? Short-term debt against long-term debt. And when should you switch from short-term to long-term? Advantages of short-term debt. If you are a bank, banks will be willing to lend short-term usually or long-term. The usual tendency is banks prefer to lend what?
Short term.
Yeah, banks prefer to lend short-term. No, it's TOD is easier perhaps to obtain than a POD. Right? Short-term debt is preferred, and the amount of paperwork that goes into a housing loan is much more than what a bank might look at when it comes to a personal loan. Short-term debt is preferred by banks. It might be easier to obtain short-term debt. Right? So short-term debt easier to obtain, usually cheaper. Usually short-term debt is cheaper. And of course, repayment may be possible without penalty, right? If you settle your housing loan, there might be a penalty. But if you settle your credit cards early, there is no penalty, isn't it? Banks will give you 50 days credit, 60 days credit, and if you settle early, no penalty at all. Right? You can even settle on day one. Disadvantages: short-term versus long-term. Short-term, if you have a long-term facility, then you're guaranteed that the facility will remain until it matures. But if it's short-term, all of a sudden the bank might say, we are unable to lend. We don't lend anymore. So the risk is higher. The required repayment comes quicker, and the company may have trouble rolling over loans. So subject to that, you have to decide whether you're going for long-term or short-term. Clear? Right. So any questions? No questions? Right, if there are no questions, we can wind up for today, and I will see you all next week. So stay safe and have a safe week. Thank you very much. I will see you next week.